Should your first home that you buy, should your first home be an investment property? Man, I'm going to answer this the way that I think the question's being posed. I'll answer it both ways. If somebody says, I don't own a home and I want to maybe get in the real estate game, should I buy an investment property and then rent it out? My answer would be no. Here's why. When you and I've owned many rental properties in my life. We had Caroline and I had 16 long-term rentals for better part of 15, 16 years. So I've been in that game. It's a wonderful game to be in, by the way, but it does take some fortitude and some financial ability to sustain some hard times. Because if you don't own a home, let's say you got a ton of money in the bank and you buy an investment property, that's fine. Good for you. But the reality is you get better financing terms when you buy an owner occupied home. So and if you live in it for 2 out of the 5 years, so let's say you live there for 2 years, when you sell it, you avoid capital gains. So what I typically recommend is if somebody's on that fence, hey, I want to get in the rental game, go buy a home, move into it, live in it at least a year. Because when you sign stuff at closing, you're saying you're going to live there at least a year when it's owner occupied. Live there at least a year. I would even suggest maybe 2 if it's your first one and you're just getting started, just because you can then sell it and avoid capital gains. So even if you did it, you lived there for 2 years, rented it out for 1 or 2 years, maybe appreciated, you pay down the balance, you want to go buy something new, you can sell it and get tax-free money on that capital gains, up to a certain dollar amount. If you're single, it's 250. If you're married, it's 500,000. So you can get this exemption that is super sweet when you buy an owner-occupied home, and when it's owner-occupied, again, lower down payment requirements, could be even zero down, depending on what you're buying and where you're buying. Could be 3.5%, 5% down. Point is, lower down payments compared to your traditional investment properties. Investment properties are going to need 20%. So less money down, which means higher rate of return on investment. I would say rate of return, but return on investment, because if you put 5%, the house still appreciates the same it would whether you're living there or not, right? From an appreciation standpoint. So you get higher ROI, you get better things to do. And then if you want to buy a next investment property, go buy the next one while you're living in this one at least. So that's my 2 cents. I am passionate about this, about investing. If you're thinking about it or want to do it, reach out to us. Love to talk to you one-on-one. We occasionally do classes and seminars for these kind of things as well. Let us know if you have questions, but we'd love to join you on that journey. I have a lot of opinions and experience, wisdom comes from experience. So things I've done right, many things I've done wrong. Happy to share those with you. So love your feedback. Reach out to the Mortgage Mark team if you got any questions. We are here to help. And as always, when you think mortgage, think Mark.